Hey, good morning, everybody. Welcome into this week's long form episode of Mining Stock Daily. I'm Trevor Hall, your host and president of Clear Commodity Network. Thanks so much for joining us. We've got an hour-long conversation with the founder CEO of GraniteShares, Mr. Will Rhind. We go in depth about kind of this current state of the market. We recorded Thursday morning, about 24 hours prior to Jerome Powell's Jackson Hole comments, so we had no say in what's about to happen here from Jackson Hole and what the market reaction might be. We just kind of talk general interest rate themes and what it's going to mean for this cycle. But we do dive in to the ETF market. I challenge him and work with and ask him questions on leverage ETFs, and also kind of pose the question: will we ever see a day where there's a triple levered long Newmont ETF? It's not out of the possibility. So great conversation with Will Rhind. He spends a lot of time with me and kind of obliges in some of my theoretical questions. Special thank you to Equinox Gold, Vizsla Silver, Integra Resources, and Revival Gold for their continued support of Mining Stock Daily. And we will have a wonderful weekend, everybody, and be back next week. Maybe news picks up, but we are also preparing for the Precious Metals Summit at Beaver Creek. So lots happening there in a couple of weeks' time. All right, here's my conversation with GraniteShares' Will Rhind. Welcome back in to Mining Stock Daily. In this long form episode, we're going to tackle a lot of different topics here and some general themes that are hitting markets, not only in the precious metals and the miners, but also generally in the big board, in the macro scheme of things with the indices, the S&P and the NASDAQ. A little bit of on a teeter here this week. I will preface by saying I'm welcoming in my guest, Will Rhind from GraniteShares. We are having this discussion Thursday morning, my time. And so by the time this maybe hits a lot of people's inboxes, the anticipation for Jerome Powell and the FOMC to provide a little bit of maybe clarity at their Jackson Hole retreat will be approaching. Maybe some people will get this after that, whatever is to come from his speech, if there will be much of a speech at all. And so we're going to have a general conversation on that and just really the mood of markets heading into this. And then obviously everything will be hindsight after that. But Will, thanks so much for your time. It's a pleasure to have you on.
Yeah, thank you so much for having me, Trevor. Pleasure to be on.
Yeah. It's a little bit maybe fortuitous we get to have this conversation less than 24 hours before that, Jackson Hole anticipation. We'd probably have a lot more clarity if you and I were to, connect, in 24 hours time after that announcement. But let's talk about, I would love to have this conversation about really this anticipation. Is it going to be that dovish comment that everybody is expecting? The market and the federal executive administration in the U.S. really pushing for a 50-point basis cut come September. Will that provide some clarity? Or I've also heard some skepticism, and I actually would be one of those skeptics myself. Maybe it's just my natural nature to be a little bit of a skeptic here, but I mean, not that it could be a repeat of 2022 where it was, 6-7 minutes and scared the living hell out of markets. Not saying it's that, but maybe he pulls the strings in and keeps some autonomy with the Federal Reserve. Where are we at? I mean, where's this balancing act right now in your mind, and how are markets kind of anticipating this?
Yeah, I mean, I think first and foremost, we're in that middle to getting into late August period. So naturally there's some, quietness, if we can call it that, but a bit of quiet in markets. And so we've seen this sell-off over the past sort of few days that I don't think is really driven by anything other than perhaps, the sort of summer doldrums, but definitely now eyes on Jackson Hole with a view to anything particular of interest or note coming out. I personally don't have, high expectations that we'll see anything really notable. I think if anything, it will be Jerome Powell kind of laying the table for a rate cut, in September, maybe opening the door to something before the end of the year as well. So I think that's where we are. And I think the market is sort of positioning for a move higher, like we've seen sort of last summer, et cetera, after this. So I think that's kind of where sentiment is right now. And there's a bit of a pullback at the moment, but people just looking for guidance as to, interest rate cuts. And I think beyond cuts to the next chair of the Federal Reserve, of which interviews apparently start after Labor Day. So I think people are almost looking beyond that to, who's coming next. And then obviously, will that be more of the agenda that the current administration is looking for?
When we have these discussion about the autonomy of the Federal Reserve, I mean, that's a real big philosophical question, and it can go either way, and actually has been for decades, right? But it seems like it's really at a crux right now. How important, in your mind, is it to at least keep, even if it's just somewhat of a facade of autonomy, but to keep that, kind of in check here and not allow any branch of government to become, kind of infiltrate more of that than they already have?
Well, I think it's important, but I shouldn't say that we should be sort of, slavish to that idea. I think it's also important to, question things like, the exact structure that we have, and some of that, as you've seen going on from Treasury and other parts of the administration. So I do think it's legitimate to ask these kind of questions, but at the same time, markets have clearly showed you that if there was a perception that the Federal Reserve would lose its autonomy, the market clearly reacted very badly to that because it's a change. It's a sea change in financial markets and the financial status quo. So I think it's perfectly legitimate to ask these questions, but from an autonomy perspective, at the moment, that's something that is important, and clearly markets would react negatively if there was a perceived change in that in any major way.
Yeah. It's been a fascinating, I'd say, almost 10 years since, you started GraniteShares, and obviously leading up to this point. And so I'd like to, we kind of laid the groundwork of what the next 24 hours may or may not look like
Yeah.
as you and I chat. But we do need to, I'd love to kind of get your sense of, the last 10 years of your business has been absolutely fascinating. Lots of cycles, big swings, lots of volatility at times here. And if you kind of, sit in the seat today and just kind of look back, talk about how GraniteShares continues to evolve with the market, is into now, a global presence of, $10 billion of assets under management.
Yeah, I think it's been a sort of a big, evolution over that time, and obviously continues to be so. And maybe a couple of points when we started on the commodity side, because I've got a lot of background and heritage on the commodity side, and so we started there, in an environment very different to today, and we can talk about that in terms of how far the gold market and some of the other commodities have come since then, even in this relatively short period of time. But we started on the commodity side. That was at a time when commodities were, let's just say, probably a little bit out of favor, and perhaps wasn't a major focus of investors in the way that things have changed more today. And, over time, I think probably the biggest trend that we have embraced and the biggest thing that's changed is the increasing participation of retail investors, or
Hmm.
do-it-yourself investors in the market. And that's sort of been a massive change that's come through the enablement from financial technologies, really providing access so that, wherever in the world you can, get on your iPhone and trade a stock or whatever it may be. And that's a big sort of leap forward that's helped firms like us on the ETF side. So I think that's enabled us to launch products that are more, directed towards self-directed investors, more retail-friendly things, and that's brought us into realms like leveraged ETFs, like ultra-high income ETFs, things that really resonate with that self-directed audience.
Yeah. I do want to talk to you about the leverage ETFs in this
Yeah.
conversation. I think that's a fascinating topic here that I'd like to tackle with you. But before we get there, I mean, you did mention a lot of these other kind of areas, these realms of products that you've launched. You've done some obviously large tech companies driven by AI and crypto themes are part of the portfolio. Could you elaborate on the this assessment on how it influences GraniteShares strategy? I mean, are you forced to continue to evolve with the current, um, you know, uh, momentum of the weeks to weeks of the markets?
There's definitely an element to that, but I would sort of put maybe another twist or another spin on it that I increasingly see we're talking about the largest tech companies, obviously, but I increasingly see those companies in a world where the investor is looking for safe havens. I increasingly see those companies as being a part of that mix that we traditionally used to speak about as being just gold, and then maybe we added Bitcoin or some of the cryptos sort of into that conversation. And I think that's kind of evolving now to the highest quality companies as well in that. So we're certainly, keyed in on the key themes in the market, particularly AI, which remains the top sort of investing theme, and the companies that are most active on the AI side are the companies that we still find investors are most sort of engaged in, and very much so, following the key market trends, because our job as a manufacturer at the end of the day, that's what we are. We're an asset manager, but we build
Mhm.
products for investors, and we have to build products that people want. And very much at the moment, if you're talking equities, the trend is very much in the favor of AI. The highest tech enabled companies, and also cryptocurrencies as well.
With the what is the competitive advantage? Do you say what do you say the competitive advantage of GraniteShares is? I mean, there's another, a lot of other asset managers out there and with ETF products. What is your advantage?
I think it's really down to differentiation. I mean, as an independent company, we have to clearly survive in a very competitive landscape against competitors that are a lot bigger, a lot more resource than we are. So we have to be providing unique IP. And so I think if you want to talk about competitive advantage, it's the able or the willingness and ableness to create unique intellectual property that we can then monetize in the form of investment products. So we have to be doing something different. We have to be differentiated. We have to be unique. We have to offer something that others don't, and that's really the competitive advantage that we have to have as a company.
So you said something earlier that like really caught my attention. You said we need to create products that people want. In this environment, and as a student of financial history, you can take cycles of business past and maybe place it in the current time, and you see so many different connections between booms and busts, and it really feels that, like, again, as a skeptic, it feels like we are on a precipice of a potential bust, and that you see so many things. Middle, lower class consumers are absolutely getting crushed, and you can see that in this
Yep.
week's earnings out of retail, such as Target and Walmart. Credit cards usage are really heightened, and it seems like people are having to use credit for their everyday needs. But at the same time, we have this, it seems like new leveraged ETFs coming to the market, which could be another sign of maybe a potential end of cycle type of maneuvering here. So you mentioned you create these products of what people want. the question that popped into my head, and I'd love to get your answers, like, okay, but are these products people need? And so how do you kind of balance,
Yeah.
financial history of booms and busts with the current cycle and where we're at, and continuing to have to deliver these products that people are yearning for?
Yeah, I mean, I think so first of all, to take the question about do people need them, I guess that is a very sort of philosophical question that, when it comes to investment products, I've been in the ETF industry for now, 25 years. And in some respects, people have been asking that question since day one. And there's always that, hey, do we need more products? And my answer to that question is always let the market speak for itself. We are in a free market. Investors have the ability to choose what investment they make at what particular time. With ETFs, as you probably know, they're a completely pure product. There's no financial incentive that goes into, there's no commission paid to a financial advisor or an investor. You just buy it on the exchange like a stock. So therefore, people are completely, within their own rights or at their own liberty to buy a product or not buy a product. So there's a natural selection that exists in the ETF industry, unlike, most other industries. So the need is a function of the demand. And if there's demand, meaning that if we launch a product and there's assets and it breaks even and we go through just like any normal business, we go through those basic sort of profitability metrics, then we'll continue to launch products and we try and launch more things that people want or people need. So I think one person's need is clearly different to another's. And within the portfolio of products that we have products that will be suitable for all sorts of different investors, but not for all investors. The investor that buys gold is most likely different to the investor that buys 2 times, Tesla or 2 times short Tesla. And, sometimes there may be some crossover, but fundamentally, there are products that we have that are higher up on the risk reward spectrum, and there are products that we have that are much lower down on the risk reward spectrum. So it's really like the tools in the toolkit analogy that there's a tool for everything. It's a question of, what do you want and what job are you doing? And therefore, what's the best tool for that job at that particular time? So that's the way that we think about it. And I think, again, the beauty of the ETF market is it's just a pure demand driven market whereby if there's demand for something, people like me will supply it. And if we supply something that people don't want, it will be a flop and it will, disappear.
Yeah. Did the ETF passive investing become a global phenomenon? I mean, I think some of the things heard is like growing about up to 30% annually. A lot of other kind of analysts that do deep dives that we've had conversations with sometimes describes it as somewhat of a house of cards, and wondering how long can passive investing continue to maintain this momentum. So I guess I'll leave that question up to you. Is like, what is the long-term outlook for the ETF industry? If, say, you and I touch base 10 years from now, what would you expect that to look like?
Well, I expect massive growth from where we are today. So I'd sort of answer that question in a couple of different ways. So first of all, people have to think about ETFs as being just the new technology, and the new technology in asset management that replaces the old technology, which is mutual funds. So ETFs are just a new form of the mutual fund that will replace that older technology and become the dominant investment vehicle. So from that perspective, the market, ever since I've been involved, has been growing at that sort of 20 to 30% longer term compound annual growth rate. And we expect that to continue over the next decade. Now, within that, we also have to sort of delineate between what people typically refer to as passive investing to ETFs. And within this realm of passive investing, what most people are typically talking about are the largest, most well-known indexes like an ETF on the S&P 500 or an ETF on the NASDAQ 100, something to that effect. And those are almost in a category of their own because they're like the Coca-Cola of the soft drink world. Like there's a lot of soft drinks out there, but everybody knows what Coca-Cola is. And if you're sometimes looking to buy or to consume a soft drink and you don't particularly want to think too much about it, you go to the brand or the name that you know. And that's really what happens with investing as well. And so if you're talking about the marginal dollar allocation, that market share, that marginal dollar will 9 times out of 10 go into one of these large generic indexes that people know about. And that will continue for so long as that investment remains valid. In other words, that underlying index, and if we're talking about the US market, we're talking about the S&P and the NASDAQ, so long as they keep performing. But guess what? If we get, multiple years of, down S&P down XYZ, then, that investment will shift just like everything else. But I think the trend of ETFs and the different things that ETFs can offer obviously is live and kicking. That will just continue to expand, will continue to increase as the assets sort of turn over from the old legacy mutual funds.
Okay. So in the ETF space, and correct me if this hypothesis or this observation is wrong here, Will. Obviously, there's a number of like very prominent ETFs there, which anymore are really focused on some specific, a small amount of very specific companies, and so you have this crowding risk. And you can this is why we have the Mag 7, right? Like we have
Yep.
7 companies that have kept up the NASDAQ, the S&P. 2 of those companies make up what was 15% of the S&P. Arguably a very dangerous ratio there, I guess you could say. But you do have this crowding risk. How do
Yep.
your products kind of, or how can you mitigate this concentration? On one hand, you have to give the people what they want. You have to deliver the products where the business is, but at the same time, there's also a risk mitigation on your part that if something does go sour, that you need to kind of mitigate. So how do you balance this?
It sort of goes back to, what the different types of ETFs. So again, that is really only an issue in the largest ETFs on the largest indexes. And that's where the strategy of market capitalization weighted indexes sort of rewards the biggest companies. And it rewards the biggest companies and therefore the biggest companies that also are performing the most. So it's a self-fulfilling prophecy in some respects. And it goes back to my saying that only works in an environment where the market goes up, those companies go up. I think if there was a sea change and clearly markets were to go in a different direction, then that sort of philosophy wouldn't be as relevant or wouldn't work clearly as well. In terms of what we do, I mean, we don't offer ETFs like that because we don't compete directly with the BlackRocks and the Vanguards of the world in that space. So our ETFs, although they might have some components of those particular indices, again, we're providing ETFs that have market exposure, whether it be gold or whether it be equities or income. We have to provide these flavors that are different. And so the crowding thing is not something that's relevant to us per se, but it's a relevant question for the indexation market as a whole, and as the increasing the share of passive money tracking these major benchmarks increases over time.
Are you at all worried, or maybe not worried is the right word, but maybe curious if we are in the midst of a sea change right now? I mean, we've got markets at all-time highs, 4 down days here this week, led by tech stocks. We've seen this before. The dip could be bought and we're back, smooth sailing next week. I get that. But
Yeah.
I have to ask, I mean, is there anything that you're seeing out there that maybe gives you a little bit of maybe curiosity if we are on the verge of some sort of change?
I don't think so at the moment. To me, you have to discount this being mid-August as being a sort of summer doldrums. The depth and breadth of the market, the volume in the market, it's always lighter this sort of time of year, and you can get these moves. I think this is another dip that will be bought, and will continue to rally, as we come into the year end. But like all these things, we've yet to really see if there is any longer term impacts of the major policies that have been enacted and are in the process of being still in the process of being enacted this year, namely the trade war, the tariff policies, and whether there's longer term effects. Short term effects seem to be marginal, if non-existent at all. But the longer term effects yet to be seen.
Yeah. We will see. I feel like I've been having this question about a couple times a year for the last 7 or 8 years. Like there's a little bit of a scare. People wondering, well, is this the time the market's finally going to roll over? And sure enough, the gunslingers out there, the ones that bought the dip, or still live to fight another day and doing better. The ones that are a little bit concerned,
Yeah,
are missing out. But there has been some interest back in the precious metal sector. Obviously, the East, the Asian buyers have been coming in hand over fist over the last couple of years here, Will. I'm just kind of curious, I mean, because you've been involved in precious metals for some time and you have products in precious metals. What are you seeing from the Western investor or with capital allocation to precious metal sector? And how much of that has attributed to gold's rise here in the last 18 months?
I always think of the US investor as more momentum driven. So there is a big part in the inflows that we've seen into the gold market year to date in gold ETFs. I think there's clearly a big part of that that's momentum driven. That there's a lot of people that follow price, irrespective of what they might say, to the contrary. But a lot of that is momentum. Retail will I think always be strong in terms of there's a big affinity for gold, for precious metals in terms of buying physical bar and coin, and there's a cyclicality to that business just as much as there is in jewelry. But I think fundamentally we're dealing with an environment where people are starting to, if they haven't already, to recognize the value of assets that are safe haven assets, outside of the most traditional of traditional. In other words, the US dollar. And I think in a year where you've seen the US dollar, decline by roughly 10%, year to date against the basket of currencies, you're just sort of increasing that interest in alternative assets. Gold has benefited from that, and we've seen other alternatives benefit also.
Yeah. How much of gold's moving forward is going to be predicated on the move in the dollar? And the reason I ask this is because the dollar's in an interesting position right now. It's just kind of stuck here. Maybe we'll have some clarity again tomorrow morning, Friday morning, after Jerome Powell's comments. But if you just look at the chart of the Dixie, it's making a higher low, but it's not making a higher high. It's just kind of consolidating here, waiting for whatever clarification it is that's coming our way. So it kind of feels like it could go either way here. But how much is gold's future move going to be predicated on the US dollar?
I mean, I think a lot, but I have to caution that by saying that we've also been in an environment where gold's gone to all-time highs at the same time as dollar has gone to highs, which if you'd asked that question 5 years ago, it probably seemed impossible. So there's got to be something else at play here other than just gold's historical relationship to the dollar. And I think what's at play is that it's become more than gold against the dollar. It's more about gold's place in the international sort of monetary system, and increasingly people looking to hedge themselves in a world where the US dollar and other paper currencies, fall over the long term, um, against a backdrop of increasing. I mean, I think global government debt now has pushed beyond 100 trillion, growing at 5 trillion, or 5 trillion last year. So more than the rate of inflation. And that's very concerning for people. I think if you look at the amount of just debt outstanding, not just government debt, I think we're past 300 trillion. So there comes a point where people are saying, you know what, I got to have something that is, free of credit counterparty risk. And for some people, that's gold. For some people, it's gold plus other alternatives. But increasingly, central banks, as you know, are buying gold, have been for many, many years. And I think part of that is that, gold has become the de facto reserve asset outside of the dollar. And that's really what's happening. And that's why central banks are willing to buy at any price.
Maybe walk us through the ETFs focused on precious metals that GraniteShares offers, and then is anything noticeable that you've recognized here, and maybe over the summer that is, people listening would find, attention grabbing?
So we have, in terms of physical precious metals, we have gold and we have platinum. So gold is our bar, ticker code BAR, and platinum is PLTM. So we have those two. Gold is our flagship that's been with us, since day one. And I think we haven't noticed, to be honest with you, anything I would say that was sort of, groundbreaking or anything, vastly unusual. But we are obviously in an environment where gold price has risen to highs, and within that, you see buying go along with it. I mean, maybe what I would say is we haven't seen a lot of selling, which is perhaps, maybe a good indicator of how people sort of feel about the move, how feel about positioning. Platinum has broken out. That's really the first time in many years that the platinum price has really gone on a run, alongside of silver at least. And so I think there's a lot more interest in, what's the next metal, in air quotes, after gold to do well. And, people that may thought, hey, I've missed the gold run. If you're more of a momentum investor, what's next? We've certainly seen a lot of interest in platinum. But I think, beyond that, nothing too unusual, just more interest in alternative assets, I think, across the board in terms of something that's not, stocks or bonds. And, that takes us firmly into the precious metals arena, and obviously other assets as well.
Yeah. I mean, so it's interesting, the relationship of products that you have, say, on the technology side, like you have a 2-time long NVIDIA ETF, you have a 2-time short NVIDIA ETF. These products are things that you have provided as that market had continued to progress.
Yeah.
But you haven't, it doesn't seem like you've created anything unique or new in the precious metals side for quite some time. Is that basically just saying because the market, hasn't grown exponentially like the tech sector has?
I would say it was more that we focused that on the start. We always wanted to be a business that offered multiple things. I think the goal initially was to establish what we thought of as a core commodity set. So the two kind of backbone products, if you will, were physical gold and a broad commodity ETF, which is our COMB or COMB. And at the time, those were the sort of lowest cost ways to invest in both gold and, broad commodities. And we added platinum to that. We actually had another commodity index, which didn't work out. We closed that. But we had a sort of small suite that we were really pitching to people as being that sort of core offering. And a lot of times, investors that we talk to, you're either sort of a gold person or you're more of a broad commodity person, and it's really pick one of those two. And then outside of that, we wanted to expand the business into other asset classes, namely equities, etc. But I think commodities will always be a part of the business, and it's something that we're increasingly looking at more and more now, as I think there are different opportunities that are presenting themselves, in the market.
Well, let's open that topic up. What are you seeing? What's piquing that interest in the commodity space?
Well, let's just start with a very broad statement that maybe with the exception of gold, although we can make arguments as to why gold falls into the same category, but let's start by saying that if you're looking for value out there, you've got equities at all-time highs, markets at all-time highs. You've got crypto, Bitcoin, etc. at all-time highs. Um, Commodities might be the only place where there's value out there. And so we've seen this obviously in cycles before. And, that's something I think the starting point for me is looking at the entire, asset class as being a place where I see value and, something that from a business perspective, we're going to be spending a bit more time on.
Okay, can you elaborate on that a little bit? We're spending a little bit more time on it. Are you
Well, I
adding a
think that
team to this, or
there's a macro and micro element to it. So at a macro, I'm
yeah.
talking more about our ability to either potentially buy other businesses, other funds, other sort of players, if you will, that are or having exposure to the space because we see it as a good opportunity. And then at the micro level, in terms of funds that we might be interested in, there's a lot of interesting stuff happening with commodities. Namely, if you talk about, say, the need to generate new power or much more power to the electricity grid to support AI and all the general electrification story, then you're talking about need for commodities, copper, obviously the top of that list, but other commodities along the way. There aren't really many ways for investors to get exposure to some of the rare earths, some of the other metals beyond, sort of precious and major base metals such as copper, etc. So there are a number of opportunities, I think, that present themselves in terms of, micro fund creation and, investment ideas that might be interesting to people.
Is there an opportunity to somehow position the explorers and developers into some sort of ETF
Yes.
or passive fund? Because I mean, there's so much risk in each equity that, one thing could happen to one company that's very powerful that sends them plummeting, that would hurt everybody else, right? That's kind of name of the game with these things. So how do you package this up and mitigate the risks of a very risky market already?
Well, the good news is that, liquidity typically improves over time if there's demand for a particular sector, and sort of capital inflows improve liquidity. But the ETF is not a magic bullet for solving a problem that exists today. And that could be, for example, in the case of some of the explorers or liquidity. So what we have to be careful of, and typically this is the number one rule for any ETF, is it has to be liquid. And that means that there's no cap on the flows that can come into an ETF, and therefore there's no cap on the outflows that can go out of an ETF. So typically we're talking about underlyings that are liquid. And, one way to solve or address a liquidity problem is to add more stocks, into that basket, and therefore you have some more protection. But if the underlying stocks themselves are not liquid, there's not really that much that an ETF can do to solve that problem. And if anything, it would make it worse because you're attracting capital, into an asset that's not liquid or not able to support it in the right way, and therefore you'd have all sorts of potentially, adverse price discovery issues. That being said, I think my experience over time is that the more money that goes into these markets, into these investment ideas, what we once thought of as being perhaps maybe not illiquid, but less liquid. The liquidity improves, as demand, as capital moves in the space. And ETFs have had a great track record of doing that in terms of providing market access to areas of the market that have been tough for people to invest in before, and do that in a sort of liquid and transparent way. So it's all an evolution, but absolutely, the further downstream you move in terms of market cap, the more challenge you're going to have with liquidity.
Yeah, absolutely. And it just that's what makes it challenging for companies that are maybe explorationists in nature, traded on the venture exchange, little liquidity or less liquidity out of the
Yeah.
Canadian markets. More of those companies trying to get better established so they can move a listing to NYSE or the like, a bigger
Yep.
board, obviously. And that's a theme that continues to keep popping up. Well, how closely do you pay attention to the small cap explorers and maybe even developers? And are there any themes that you're picking up here in that earlier stage of operation that maybe you see has legs in in this cycle?
I don't pay a huge amount of attention to it, and that's not because I'm not interested. It's just that I have a limited amount of time. I have to focus, on running the business,
Right.
on the priorities of the business on any given day. So typically, it would come on my radar if we were looking out, or if someone presented us with an investment idea, which people typically do. And the way that a lot of ETF creation happens is through index providers or third parties, which will create a strategy. And it could be, for example, as you mentioned, it could be junior miners, explorers, whatever it may be. And they might create an index, create an investment strategy, come to us and try and get us to commercialize that in the form of an ETF, of which we'd look at it, evaluate it, and obviously decide whether to do it or not. So it's not something that I spend a huge amount of time on, but it would cross my radar, as and when investment opportunity kind of presented itself.
Okay. So what the opportunities that are maybe present that you see, not something that you're actively acting on, obviously I'm not asking you to, share the farm here of what's happening in the background of Granite Shares, but there's with the themes that have come up in the last 6 to 8 months here, Will, I could think of, you know, copper production development out of the United States, gold developers and miners, out of the United
Yep.
States, rare earth type of opportunities with all it's basically on the back of this reshoring, the United States reindustrializing, reshoring. Is that something that is present
Yes.
as opportunities that could be potentially offered for new products?
Absolutely. That is an area that we've looked at. I think the challenge is always in the construction in terms of how you deliver it. And so delivering, if it's like, say, physical underlying, like who's going to custody it, who can custody it, who can provide that liquidity, that price discovery, that market making that you need to provide a liquid product. But those are exactly the kind of things that, going back to one of your original questions about the sort of the want and the need for products, like the market's always changing. And, in the change creates opportunity. And so regardless of what's going on, there's always something, the economic environment is always changing to some degree. And there were things that will remain the same, but there are things that will change, and that creates the economic opportunity. Whether it's a high interest rate environment, a low interest rate environment, high growth, low growth, inflation, no inflation, specific government policies, of course, regarding manufacturing, et cetera, industrial policy. Those will all sort of in the way have a dictation on the kind of products that people want. I mean, defense, for example, has been a big theme over the last couple of years, as both the United States, European countries, even some Asian countries, ramped up spending on defense. And so, there are always these opportunities, and commodities, will always remain kind of at the center of that.
Yeah. Um, So I want to have a fun question with you, and just kind of think about where we're at in the cycle on the tech side, and if we were to have something similar on, say, the precious metal side. So, for example, hypothetical, like a lot of people watching markets, financial historians will say, "Oh, well, if there's a triple levered short Nvidia or triple levered long Nvidia, whatever, you know, there we're at this height of the cycle, like
Yeah.
risk is full bore." And maybe it's time to pull back. If we ever get to a time where we have a triple levered Newmont ETF, would that be a sign that maybe this precious metal cycle has maybe run its course?
Um, I think it could certainly be an indicator. Um, the interesting thing about that is it's a question of, do people view? I mean, the one thing that'd be interesting to me is you wouldn't normally associate that with the sort of speculation that exists in some of the more momentum driven stocks. So if you got there, it might well be an indicator, because people normally wouldn't be doing that kind of trade. Um, but yeah, I mean, I think it's a function again of the supply and demand. If you have a product where people want to be leveraged on Newmont, I can guarantee that's in an environment where Newmont gold stocks are screaming, and you've got people on CNBC all the time saying that gold stocks are the new tech stocks, and all the things that would accompany a mania that we've come to know and love in so many things over the years.
If I live to see the day where there's a triple levered Newmont ETF out there, like I will think, yeah, I'll be pounding the table in
Hey,
excitement,
it'll
I
be
think,
there if
for at
there's
least one.
demand. It will be there.
That's right. That's right. And obviously, GraniteShares and you and the team will be there to offer it. Will, thanks so much for your time. We covered a lot of ground.
Yeah.
It was a lot of fun. I hope you had fun in this conversation. I did challenge
No,
a couple
absolutely. Yeah,
things.
great talking with you.
How can people? I mean, obviously, people can find GraniteShares, but how can people find you personally in your work?
Yeah, so I think for me, X is probably the forum that we're most active on. But people can find me at Will Rhind on X, also on LinkedIn as well, and then obviously the company site or the company pages at GraniteShares on the website or on X also.
Okay. All right. Will, thanks so much. Have yourself a wonderful next couple days, and we'll chat again soon.
Thank you so much, Trevor. Appreciate it.